How the market reflects your inner flaws. Trading often begins with a simple idea, the promise of freedom, the promise of control, the promise that numbers, logic, and discipline can turn effort into reward. At first, it feels mechanical. Charts, indicators, rules. But for those who stay long enough, trading reveals something far deeper. It becomes a mirror. Not a mirror of price, but a mirror of the self. Not a reflection of strategy, but a reflection of character. The screen does not show you the market. It shows you who you are under pressure. Most traders believe the market is the obstacle, that it is chaotic, irrational, or unfair. They search endlessly for better systems, better indicators, better entries. But what they rarely question is the one variable present in every trade: themselves. The market is neutral. It does not care about your goals. It does not reward your effort. It does not punish your mistakes. It simply responds. And in that response, your inner world is exposed. Impatience is usually the first flaw to appear. It disguises itself as ambition, as motivation, as hunger. You see movement and feel urgency. You fear missing out. You fear being left behind. So you act early. You break rules. You justify weak setups. At first, impatience feels productive. It feels like engagement, like decisiveness. But over time, its cost becomes clear. Most losing trades are not caused by bad analysis. They are caused by emotional urgency. The market was never moving too fast. Your mind was. Impatience does not shout. It whispers. Just this once. You'll manage the risk later. It's obvious where price is going. And slowly, discipline erodes. The trader begins to notice a pattern. Losses cluster around moments of haste. Errors appear when urgency dominates awareness. The screen reflects impatience perfectly. It magnifies it. It exposes it. Then comes vanity. Vanity is more subtle, more dangerous. It is the desire to be right, to predict, to feel superior. Vanity convinces the trader that skill overrides probability, that experience makes rules flexible, that discipline is optional. Vanity does not always lose immediately. Sometimes it wins, and that is what makes it dangerous. Small wins inflate confidence. Confidence inflates ego. Ego bends rules, and eventually the market reflects vanity back in the form of large, painful losses, not as punishment, but as consequence. Fear arrives later. Not panic, not terror. Fear appears as hesitation, as doubt, as early exits and missed opportunities. Fear is not weakness. It is information. It reveals attachment. Attachment to outcomes. Attachment to self-image. Fear exposes lack of trust in process. When fear is ignored, it controls behavior. When fear is observed, it loses power. Trading teaches this brutally and honestly. At some point, the trader realizes something unsettling. The market is not difficult. Self-regulation is. Charts are easy to learn. Indicators are easy to apply. But controlling impulse, ego, and emotion is profoundly difficult. Trading is not a technical challenge. It is a psychological one. This is where the journey changes. The trader stops obsessing over prediction and starts observing reaction. He notices his breathing during entries, his tension during drawdowns, his thoughts after losses. He sees that every emotional reaction creates a distortion in perception. The chart becomes less important than the mind observing it. Waiting becomes a skill. Not passive waiting, active restraint. Sitting in front of the screen doing nothing becomes harder than trading itself. Boredom tests discipline. Stillness tests ego. The urge to act becomes the enemy. The trader learns that not trading is often the most profitable decision. Losses begin to transform. They no longer feel like personal failures. They become feedback. A loss reveals impatience. A loss reveals overconfidence. A loss reveals emotional interference. The pain is not the loss itself. The pain is resistance to learning. When resistance disappears, losses lose their emotional charge. Over time, emotional volatility decreases. Wins no longer create euphoria. Losses no longer create despair. This neutrality is not apathy, it is clarity. The trader stops measuring success by profit and starts measuring it by execution. Did I follow my rules? Did I respect my limits? Did I observe myself honestly? This shift changes everything. The market appears calmer, not because it changed, but because the trader did. Less trading, better trading. Fewer decisions, higher quality decisions. Results improve quietly, not through brilliance, but through restraint. Eventually, the trader understands a profound truth. The market does not need to be beaten, it needs to be respected. It is not an opponent, it is a mirror. Every flaw appears on the screen. Every strength is tested. Every weakness is exposed. This awareness extends beyond trading. The trader notices impatience in daily life, ego in conversations, fear in decisions. Trading trained self-observation. Life applies it. The market was never the destination, it was the training ground. Mastery reveals itself quietly. There is no final victory, no moment of arrival, only consistency, clarity, presence. Trading becomes less dramatic and more powerful. In the end, the trader understands. Trading was never about money. Money was the excuse. The real reward was awareness, the ability to remain calm under pressure, the ability to act deliberately instead of react impulsively. The screen never lied. It showed the truth again and again until the trader was willing to see it. To trade is to face yourself. To face the market is to face your own mind. And once you see yourself clearly, you are no longer fighting the market, you are aligned with it. Trading is not a battle of charts, it is a journey of self-discovery, and the mirror always reflects the truth.